They say you cannot grow small money into something meaningful, that small accounts are destined to remain small. I have seen this lie destroy more traders than any market loss ever could. But I will tell you this truth: a disciplined trader with skill, patience, and a clear method can take a small account and build it into a substantial capital base. It begins with understanding one simple fact: scaling is not about luck, it is about process. Every step you take must be deliberate, every trade must be controlled, and every decision must respect both your system and your capital. Scaling starts with small trades, trades that you can manage, trades that teach you control. If you cannot protect $100, you cannot protect 1,000. If you cannot manage fear and greed with 500, you will not manage them with 5,000. This is the training ground. Here you learn to take losses without panic, to take profits without overconfidence, to follow your rules when your instincts scream otherwise. Every small win is a brick, every disciplined trade a foundation. Build this first, and the structure for larger capital will be secure. The first principle of scaling is risk management. Never risk more than a small percentage of your account per trade. 1 or 2% is enough. This is not conservative, this is survival. Scaling is not about chasing the biggest win today. It is about surviving tomorrow and compounding gains steadily. When your account grows, you gradually adjust your trade size in proportion to your capital. This is the core of scaling, increasing exposure without increasing risk beyond what you can psychologically handle. Once you have mastered small trades, the next step is consistent compounding. This is where a small account can start growing meaningfully. Reinvest a portion of your profits into the account while maintaining the same risk limits. Do not withdraw everything. Leave enough capital in the account to continue building. This method turns modest gains into larger capital over time. And the key is patience. The market does not rush, and neither should you. Compounding is slow at first, but once discipline is built, it accelerates and the results speak louder than any shortcut ever could. A powerful tool for scaling is the prop firm. Many traders fail to see the advantage because they misunderstand the rules. A prop firm allows you to trade larger sums than you have while enforcing strict limits on risk and drawdown. But here is the crucial point. You must first prove you can trade a small account with discipline. Prop firms amplify your profits, yes, but they also amplify mistakes. You cannot bend the rules. You cannot overtrade, and you cannot let emotion dictate decisions. Only disciplined traders who follow their plan without deviation benefit from these opportunities. Before approaching a prop firm, understand your edge. Know your system, your win rate, your average risk-reward ratio, and your style of trading. Prop firms are not a shortcut to riches. They are a tool for those who have proven themselves. Start with the smallest allocation, trade within the limits, and demonstrate consistency. Once you do, you can increase your capital exposure step by step. The prop firm allows you to leverage skill, not luck, and that is the true advantage of scaling through this method. For self-funded accounts, scaling requires incremental growth and diversification. Start with a small, manageable account. Grow it gradually by compounding profits. When your account reaches a comfortable level, you can diversify into other instruments or markets using the same rules and strategies. This spreads risk while increasing opportunities for profit. Remember, scaling is not about gambling. It is about measured growth. Each step forward must be justified by your skill, your consistency, and your ability to manage risk. Psychology is as important as strategy. As your account grows, your emotional exposure grows too. Fear and greed magnify when more money is at stake. The trader who panics at $500 will panic at $5,000. The trader who chases at $500 will chase at $5,000. This is why scaling gradually is essential. Your mind must learn to handle increased responsibility before your capital increases. Discipline at small levels translates directly to discipline at higher levels. Each stage is a test. Pass it and you grow. Fail it and losses compound. The mathematics of scaling are straightforward. Trade a small percentage of your account, reinvest profits, and gradually increase position size as your capital grows. But mathematics alone is useless without discipline. You can have the perfect formula, but if emotion overrides reason, your growth halts, or worse, it reverses. The market does not care about desire or ambition. It only reacts to skill, patience, and execution. True scaling is a balance between calculated risk and emotional control. Let us consider a practical approach. Suppose you start with a $500 account. You risk 2% per trade, or $10. You have a system that wins 60% of trades with a risk-reward ratio of 1 to 2. Over time, consistent application of this method allows your account to grow steadily. As your account reaches $1,000, you adjust position size proportionally, never exceeding your comfort level. You compound gains, keep losses small, and repeat the process. In time, your account doubles, triples, and grows beyond what seemed possible when it was just $500. This is the power of controlled scaling. Many traders fail at this stage because they allow impatience to dictate decisions. They see opportunity, increase risk too fast, or abandon the rules that made their account successful. This is where most accounts blow up. Scaling is not about speed. It is about controlled progression. Treat each step as a test. Have you followed your rules? Can you manage losses without panic? Can you increase position size responsibly? Only after passing these tests should you take the next step. Scaling also requires a long-term mindset. You are not trying to become rich overnight. You are trying to turn skill and discipline into capital growth. Each successful trade, each careful adjustment, each reinvested profit builds toward the larger goal. By focusing on consistency rather than luck, by respecting your rules rather than chasing immediate gains, you create a framework where small capital grows into something significant. This is not theory. It is the method that every successful trader follows. In the end, scaling from small to large capital is a combination of skill, discipline, patience, and opportunity. Small accounts teach lessons. Prop firms amplify gains for disciplined traders. Reinvestment compounds profits, and psychological mastery ensures longevity. The trader who respects these principles can turn modest capital into meaningful wealth, step by step, trade by trade. It is not easy, but it is achievable. And the reward is not only in the profits you make, but in the mastery you gain over yourself and your trading process. Once you have established discipline on a small account, the next step is to strategically increase your trade size without overexposing yourself. Many traders make the mistake of jumping too fast. They see a streak of wins and convince themselves they can handle more risk than they actually can. This is where scaling must be methodical. You begin by increasing your position size in small, manageable increments, always in proportion to your current capital and psychological comfort. If your account doubles, consider increasing trade size by a fraction, not the full double. This way, growth is controlled and your mind learns to handle the increased responsibility without panic. A key principle in scaling is risk per trade. Even as your account grows, you must maintain a strict risk limit, typically 1 to 3% per trade, depending on your system and comfort level. The larger your account, the more a single trade can hurt emotionally. By sticking to a consistent risk percentage, you protect yourself from devastating losses while still allowing your account to grow steadily. Discipline here is everything. No impulsive decisions, no chasing the market, no increasing risk out of greed. Reinvesting profits is the next tool in scaling your capital. After a winning streak, resist the urge to withdraw everything. Instead, reinvest a portion of your profits back into your account. This controlled reinvestment allows your trading capital to grow faster than your original deposits. For example, if you turn $500 into $800, you might withdraw $100 for safety, but leave $200 in the account to compound. Over time, this method turns small gains into meaningful capital without dramatically increasing your exposure or risk. Prop firms provide access to larger capital, often 10 to 50 times what you could personally trade, but they come with strict rules, daily loss limits, maximum drawdowns, and risk per trade. You cannot break these rules without being removed from the program. The trader who follows the rules, remains disciplined, and applies a proven system will see their profits multiplied far faster than through a self-funded account. The trick is preparation. Know your edge, document your trades, and practice on smaller capital before attempting higher leverage. Trade selection becomes increasingly important as your account grows. You cannot treat all trades equally when the stakes are higher. Focus on setups that offer high probability and favorable risk-reward ratios. Avoid impulsive trades or those that feel too good to miss. With larger capital, even small mistakes can be costly. The art of scaling is not in chasing every opportunity, but in choosing the right ones and executing them with precision. Scaling also requires tracking performance and adjusting systematically. Keep a trading journal with entries for every trade: entry, exit, size, rationale, and emotional state. Review your results weekly or monthly to identify patterns. Are you consistently overtrading? Are certain setups more profitable than others? Are losses occurring at predictable moments of emotional weakness? This data allows you to make incremental adjustments while keeping risk controlled. Scaling is not about guessing. It is about learning and improving as your account grows. Diversification is another tactic for scaling. Once you have mastered one market, instrument, or strategy, consider applying your system to others. This spreads risk and provides additional profit opportunities. For example, if you are profitable trading a single stock or Forex pair, you might expand to correlated instruments or additional markets with similar setups. The goal is to grow your capital while keeping risk proportional. Diversification should be gradual. Never overextend into unfamiliar territory without preparation. Position sizing must also evolve as your account grows. Use tools like fixed fractional sizing or volatility-adjusted sizing to scale intelligently. A $100 position in a $500 account might be appropriate early on, but as your account reaches $5,000, your position size should increase proportionally to account for the larger capital base without over-leveraging. This ensures that growth is smooth, controlled, and sustainable. Psychology remains the backbone of scaling. Fear and greed intensify as account size grows. The larger your capital, the more pressure you feel to protect it or make it grow quickly. Scaling tests your discipline, your patience, and your ability to follow your plan under stress. Many traders fail not because of lack of skill, but because they let emotion override strategy. To scale successfully, you must treat each trade the same regardless of account size. Maintain the habits that made your small account profitable. Consistency at larger scales is the difference between success and failure. Scaling is also about learning from mistakes without letting them derail you. Even experienced traders will experience losses while increasing capital. The difference is how they handle them. Take losses as lessons. Analyze mistakes and adjust your process, not your rules, accordingly. Avoid emotional reactions like doubling down, revenge trading, or abandoning your strategy. Each loss managed correctly becomes a stepping stone for higher profits. For traders looking to move from a small account to larger profits, another critical step is a gradual withdrawal and reinvestment strategy. Once your account has reached a comfortable level, you can consider taking a portion of profits for safety while leaving a significant portion in the account to compound. This reduces psychological pressure, knowing you have secured some gains while still allowing your trading capital to grow steadily. Scaling is about controlling exposure, not risking everything for one big win. Finally, remember that scaling is not linear. Growth will come in waves. Some weeks your account will gain steadily. Other weeks' losses may reduce progress. This is normal. The key is consistent application of risk management, compounding, and disciplined execution. Small, steady steps compound faster than sporadic leaps. Scaling is a marathon, not a sprint. The trader who understands this will turn small beginnings into a robust, profitable trading account over time. Once your account has reached a level where small trades feel routine, the challenge becomes managing larger positions and maximizing profits without losing control. This is where most traders fail. They have grown their capital, but their psychology has not caught up. Scaling at this stage requires discipline, precise risk management, and careful selection of trades. Never let the size of your account dictate reckless behavior. Each trade must be calculated, consistent with your system, and proportional to your capital and comfort level. At higher capital levels, position sizing and risk per trade are critical. Even if your account is 10 times larger, your risk per trade should remain within a controlled percentage, often 1 to 2%. The goal is not to chase dramatic gains, but to protect the account while allowing compounding to work. Overexposing yourself can erase months of careful growth in a single impulsive trade. Discipline in size ensures that profits compound without magnifying losses beyond what you can psychologically handle. Advanced compounding is another key to scaling profits. With larger accounts, you can start reinvesting a portion of profits into additional trades while still keeping risk limits tight. For example, after a winning streak, you may allocate extra capital to high-probability setups or diversify into correlated markets, spreading risk while enhancing potential gains. Compounding profits intelligently accelerates account growth without introducing unnecessary emotional stress or over-leverage. Prop firms remain an excellent tool at this stage, but only if approached correctly. With larger personal accounts or funded allocations, you can access significant capital to trade, magnifying profits without risking your own money disproportionately. Follow the rules meticulously. Maximum drawdowns, daily limits, and position size rules exist for a reason. The disciplined trader uses these rules as a framework to grow steadily. Those who break them risk losing both capital and opportunity. Prop firms, when used correctly, become a lever to scale faster while minimizing personal risk. At this stage, trade selection becomes more critical than ever. Focus on high-probability setups with favorable risk-reward ratios. Avoid impulsive trades based on market noise or emotion. Larger accounts amplify every mistake, so only take trades that fit your system perfectly. Over time, selective precision leads to consistent profits, compounding growth, and minimized drawdowns. Scaling is not about trading more, it is about trading smarter. Tracking your performance systematically is now essential. Maintain a detailed journal with all trades, including entries, exits, size, and rationale. Analyze your wins and losses weekly to detect patterns or weaknesses. Are there recurring mistakes? Are certain setups consistently profitable? Are emotional decisions creeping in? Scaling successfully requires constant self-monitoring and adaptation while keeping your system intact. Without this feedback loop, even large accounts can stagnate or reverse. Diversification and multiple income streams also play a role in advanced scaling. Once your core strategy is proven, apply it to additional markets or instruments that share similar behavior. For example, a trader successful in Forex might expand into commodities or indices using the same methodology. Diversification spreads risk, allows smoother growth, and increases profit potential without fundamentally increasing exposure per trade. Even with large accounts, mistakes will happen. The difference is how they are handled. Take losses calmly, analyze them objectively, and adjust where necessary, but never abandon the system that has grown your account. Revenge trading, chasing losses, or over-leveraging is the fastest route to disaster. Scaling is about compounding success and protecting your capital, not seeking dramatic wins. Each loss must become a lesson, not a trigger for panic. At the highest level of scaling, capital protection becomes as important as profit generation. A large account is valuable not just for what it can earn, but for the flexibility and opportunity it provides. Protect your capital like the foundation of a building. Every decision should prioritize sustainability, risk control, and consistent growth. Only by preserving what you have can you continue to scale and take advantage of opportunities when they appear. The climactic truth of scaling is that it is as much about personal mastery as financial growth. The trader who turns a small account into a large one has not only grown their capital, they have grown themselves. Patience, discipline, strategy, and psychological control compound just as powerfully as profits. The real reward is not the number in the account, but the skill, confidence, and resilience developed along the way. To scale successfully, remember these principles. Start small, master risk management, and compound profits intelligently. Reinvest profits, use prop firms judiciously, diversify strategically, and maintain discipline at every step. Focus on high-probability trades, manage your emotions, and protect your capital. Every stage of growth is a test of skill and psychology. Pass these tests consistently and small accounts transform into substantial, profitable ones. Scaling is not easy, and it is never guaranteed, but it is achievable. The market rewards preparation, discipline, and patience more than raw ambition. Step by step, trade by trade, profit by profit, a small account grows into something meaningful. You do not need luck. You need method. You do not need shortcuts. You need consistency. The trader who masters themselves, their system, and their risk will turn modest beginnings into financial success. The size of your account is limited only by your skill, discipline, and patience. Control your mind, follow your rules, and the market will reward your preparation. Scaling is a journey, not a race. Each step builds upon the last. Each decision compounds your capital and your confidence. Those who endure, who apply themselves with discipline, and who embrace the process will discover that small accounts can indeed become large, profitable, and transformative, not just financially, but personally. Master your capital, master your mind, and scale deliberately. Every step forward is earned, every trade a test, and every increment in profit a reflection of your mastery. The journey from small to large accounts is challenging, but it is also the ultimate proof of your growth as a trader. Grow your skills, grow your discipline, grow your account, and the profits will follow. If you are ready to take your skills to the next level and challenge yourself, check the link in the description for a recommended prop firm, where disciplined traders like you can start scaling with real capital. Do not forget to like this video, share it with fellow traders, and check out our other videos to continue building your trading mastery. Your journey to scaling bigger profits starts here, step by step, trade by trade, with discipline leading the way.